Macron. So looking at Macron, Broadcom. So Broadcom designs, develops, and supplies a broad range of semiconductor and infrastructure software solutions. Uh, Due to the financial performance of Broadcom, right? Now, the net income margin is below industry average of 8%. Not that impressive. Good news, however, is that the margins have doubled. Well, they've more than doubled over the 3-year period. They went through an average of about 10% for 2019 2020 to well over to about 25% for 2021. So that is good. That is pleasing. Good sign, of a thriving business in the face of COVID as well as tough competition. Cost control is pleasing. It has contributed to growth in the net income margin. R&D as a percentage of revenue, it's pleasing to a degree. It is in line with industry average, so you really cannot complain about it. I mean, they're performing in line with competitors, with the rest of the industry norms. Okay, so not really that bad. So proper cost control has resulted in um, a return on these costs, because we look at the fact that they've reined in costs either increasing at a decreasing rate or flat out decreasing the form of R&D growth. So they really reined in costs, and this reining in of costs, it has protected margins. We've seen margins have ballooned, but also look at that, a return in the form of growth in revenue. So that is a good sign right there. Now, if you consider the fact that proper cost control, it has contributed handsomely to the growth in, you know, not just the top but also the bottom line in my net income, which is very pleasing. So it has underperformed the industry in the form of the net income margin. But you look at proper cost control has led to returns, it has protected margins, it has improved the bottom line of my net income. It is satisfying, with satisfying performances, R&D as a percent of revenue in line with industry average. But it's a, it's a pleasing performance, a decent performance. Now the ROE, the return on equity, below industry average, but has significantly improved from 2019. So that is the improvement as well. To me, it's pleasing. Now, the improvement is of course supported by solid growth in revenue, stable margins, and good cost control. So good financial performance overall by Broadcom. The financial position, current ratio below industry average. The industry average is 2.37, but the ratio has improved significantly over the 3-year period. Looking at what it was in 2019, 2020, and 2021, there's been a significant improvement. That is healthy. Asset test ratio slightly underperformed the industry average. Slightly, the industry average is about 1.88. Broadcom asset test is 1.82. So it's closer to its asset. It's closer to the asset test is closer to industry average. Not that far. There is underperformance, but it's really not that far. Now, the main catalyst for the significant improvement in the asset test as well as the current ratio is the explosion of cash on hand. I mean, well, Broadcom has over $12 billion in cash. A lot of it is due to the fact that it has increased its borrowing base. Both both ratios, in my view, underperformance, but they're pretty solid. Um, you look at the current ratio, Broadcom has well over 2 times the current assets to cover the current liabilities. Asset test, same thing, well over 2 times liquid assets to cover with the current liabilities. So overall, it's a strong financial position just looking at those two ratios. No liquidity risk in my view. Now the inventory days has overperformed the industry average. The industry average is just over 101 days. Broadcom's inventory days are on average 37. So massive overperformance. That is very good. That shows me that there is no risk of inventory being obsolete because Broadcom does not hold inventory for longer than what it has to. Strong margins in the form of my net income margin because what? The more you hold on for inventory, the more holding costs you're gonna have to spend. The more holding costs, that's gonna hit your bottom line. So there's no burden on my margins in the form of increasing holding costs, no form in the burden of the balance sheet in the form of liquidity, so holding on the stuff for way longer than you need to. So the inventory days ratio read with the current and asset days ratio show me a company that is in a strong liquid position. The balance sheet is very liquid. That is very good. The debt to equity, however, at a at an average of 197%, almost 200%, is above the industry average is 126%. Now that shows me a heightened increase in financial risk. Yes, I understand there's a productive relationship between debt, risk, and returns being the ROE. Yes, there's a productive relationship between the two. You know, Broadcom on average has been quite productive in achieving returns on capital invested and has been productive in the use of its debt. However, at almost 200% on average, above the industry average of 126%, very risky. You know, very high debt levels that need nip. Cash position, very good, very good. At first glance, are very good. The cash margin, the cash from operations margin, has significantly improved and is overperforming the industry. The industry average for cash margin over the 3-year period is 32%. Broadcom is achieving 48%. So what this ratio tells me, on top of the overperformance, that is overperforming the industry average, which is very good, that it converts 50% of revenue into cash from operations. That is a very good number. That is just fantastic. Um, yeah, fantastic ratio. I'm happy with it. It is impressive. Shows me that Broadcom's business model can generate cash from its operation. Very good. The sufficiency of cash flow, however, slightly under, well, not slightly under, always disappointing. It has underperformed the industry average. The industry average is about 0.84. The average for Broadcom is 0.44. So it is very disappointing. Has been improving. However, this just paints a picture of a company that's, well, paying a lot of debt. You know, quite a lot of the cash flow goes into, well, repaying debt. Now, I'm not anti-debt, but I'm not anti-debt. It's just that I have a risk appetite with too much debt just turns me off a company. I mean, if you're recording this much debt, um, your financials have to be out of this world. I mean, they are good. Don't get me wrong. I mean, they are close to out of this world. Looking at the strength of the liquidity, looking at the increase in margins, top and bottom line growth. Good, but it needs to be out of this world. I mean, that to me is just too high. It's just I'm not against debt, but that's just too high because and you can see the effect of high debt on the sufficiency of cash flow because you could end up having a situation where you well run into trouble. And what you basically just run into trouble. Where you're investing way too much in repaying of debt and withholding not that much to pay for shareholders. I mean, in this case, they are paying a decent rate, but if you don't have enough cash, it's a bit of a worry considering how are you going to respond to competition. So I mean, I'm not against debt. It's just high debt levels do make me nervous. Now you can see with the increase in debt comes well the fact that you're basically going to underperform the industry in some metrics, especially the cash flow metrics. However, let's move on. Like I said, my risk appetite, I cannot stomach such high debt levels. All right, the dividend yield, like I said, it's pretty healthy, slightly below the industry average of 46, but very, very healthy. The P ratio is fairly decent, considering the industry average just over 40, and Broadcom's PE is just 38. So it's relatively a cheap company. However, yeah, for me, it has too much debt. I understand, with COVID and all of that, but it has way, way, way too much debt for my liking. Considering, it makes so much cash, I don't get why you need that much debt. But like I said, it will be investor dependent. For me, my risk appetite, that's just too much. But good company, good growth, top and bottom line, healthy margins, strong balance sheet. The financial risk just makes it a bit unattractive.